If you are interested in Google stock, this video is for you. The stock is down 25.6% year to date, and I think we are getting a very timely opportunity to buy Google because this thing is a very high quality company and rarely ever sells off this much. If you're new here, I'm Austin. I'm building a $1 million portfolio right here transparently on YouTube. Here is the current value of my portfolio, $88,176. I have put in $92,900 and we're down about $5,000. I do portfolio updates on Fridays on the channel, so just like this video and subscribe to the channel if you want to get those updates. Here's the stocks I own. I do not own Google, and so I just want to be clear about that since I'm talking about Google in this video. All right, my first requirement for a high quality stock is I want it to be a long-term market beater and a long-term winning company. This is Google's performance over the last 18 years. The stock has compound growth rate of 22.6% versus the SPY at 7.9%. That turns a $10,000 investment into growth of $397,900, which is life-changing type money. Compared to the S&P 500, $10,000 investment, you would have received $6,126 in dividends, which is pretty great, and it would have grown $35,263 for total growth of $41,390, which is still great. $10,000 into $51,000 is great, but not nearly as good as Google. Let's take a look at the last 10 years. Google has still outperformed the S&P 500, 19% to 12%. And then over the last 3 years, even if with how bad the stock has done, it is still compounded at 18.8% versus the S&P 500 at 9%. So let's talk about valuation. Let's talk about the PE multiple and if it's high, low, or right in between. As we can see over this time period, since 2003, the average PE ratio for the stock since that time has been 30.75. The blended price to earnings ratio is currently 20.4. That sounds a lot lower, and you can see that by this line right here, the stock price being below the average PE. We can see it's lower, right? But it's not a screaming deal like it looks like right here, and I'll explain why in just a second. Over this time period, since 2003, the earnings have grown on average at 36% per year. They are not going to grow earnings that fast ever again, because at least not on average, because back then they had a lot less earnings. It was a smaller company, less revenue. It's a lot easier to grow faster at that time. So we have to take this out when we're thinking about the averages moving forward. So let's get a better idea of what a normalized PE ratio would be for this stock based on more recent numbers. I've changed this timeline up and I think it gives us a much better view of the stock, its potential earnings growth rate, and a PE that we could think about. So since 2011, if I also take out the insanity that happened after COVID, we get an average earnings growth rate of 13.46%. The normal PE ratio has been 22.8, which is still pretty high. It's above the average market, but it gives us a much better place, right? And so right now, the blended PE is 20.4, which is still below that 22.8. But what this tells us, if the earnings are going to grow around 13%, then something around a 22 or maybe even a 20 or a 19 is a good place to think for the PE ratio for the quality of this business. Okay, now we're looking at forecasting. What this does is this takes analyst expectations, and there's 46, 47, and 28 analysts with their expectations in for earnings for the stock in 2022, 23, and 24. These numbers are gonna be wrong, but they're a starting place, okay? It's a way we could think about potential return scenarios. What I've done is I've then taken that earnings down even more from that rate of 14 or 15% growth in 2024 and just put in 11% growth for 25, 26, and 27. Again, that's gonna be wrong, but it's a starting point. So now we can see what the price would be with a PE at 15. We'll do a PE of 18, and we'll do a PE of 20 in 2027. This is how I think about pricing stocks. So if they hit these numbers and Google trades at a price of earnings of 15, which is down from 20 today, so that's a 25% drop or contraction in price of earnings. So we're building in some safety here. If it trades down to a PE of 15, you're still gonna get a 5.3% return through 2027 for a per year for a 31.7% total return. That's not great, but we have a pretty good margin of safety there. If we think something like a PE of 18 is more realistic, or perhaps these numbers are going to be a little bit higher, so it's going to drive the stock price up, this is what the return could look like in 2027 with a PE of 18 or better earnings numbers from now until then. We would get a total rate of return of 58% and an annual rate of return of about 9%. So listen, we could either own an index, an S&P 500 index or something like that, and get 8 to 10% per year. That's what they've averaged. Or we can own a very high quality company like Google that is, I would argue, there's always risk of an individual company, something happening. But Google makes up a decent portion of the S&P 500. And there's so many businesses that rely on Google that if Google totally failed, it would be catastrophic for so many other companies and S&P 500 companies that, in my opinion, I would rather own a high quality company like Google than an S&P 500 index if I'm an individual investor. Because at least I'm not getting exposure to all the junky companies that I would never want to own in the S&P 500. That's kind of the downside to indexes. But anyways, at a PE of 18, you're still getting a 9% annualized return. If Google can trade at a PE of 21, which is high in my opinion, but it's not just that it would have to be at a PE of 21. If these earnings numbers are better than expected here or better than this forecast, it's going to drive the earnings number higher. So the stock would trade at a higher price anyways, and it wouldn't be at a PE of 21. It would be at a PE of 20 or 19 because they would have more earnings. Hopefully that makes sense. But it just gives you a range of prices and scenarios. So anyways, if they do better than expected or trade at a higher PE of 21, you could get an annualized rate of return of 12% for an 84% total return. So this range of returns is kind of how I think about the stock price. And when I think about the safety and the quality of the company, it's almost a no-brainer if you're comparing Google to, index style investments or other companies in the S&P 500. So let's do one more quick way we can do this is kind of build out a little model right here, right? And I did a 5-year analysis looking at revenue growth, profit margin, free cash flow margin, PE, price to free cash flow, and desired return. Where did I get these numbers? Well, over on Ticker, TIKR, they have analyst expectations, and you can get the compound annual growth rate of things like revenue and earnings over time based on what analysts are currently expecting. So I just threw that in here, and basically they're expecting a compound annual growth rate in revenue of 12% from now until 2026. If we go to net income margin, that's also another line item in that little model. They're looking at 25.5% profit margin at that time. So let's jump back over here. For the low scenario, I've put 10% revenue growth. This is over the next 5 years. A mid scenario of 12% revenue growth. A high scenario of 14%. I feel that that's pretty realistic range. A profit margin of 24, 25, and 26% because it's kind of that 25.5% expectation. Free cash flow margin, we can see historically it's been a little bit lower, so we'll just stick with that. 23, 24, and 25. PE over the last year, it's been 19.67, but we're going to bring that down 16, 18, and 20. Again, S&P 500 trades at, around 15, 16. I think this is a higher quality company than the average company in the S&P 500, so maybe it deserves a little premium. And then price to free cash flow, again, just a little bit higher there than PE. And desired annual rate of return, 10%, 10%, and 10%. We hit analyze, it's going to give us a low, a medium, and a high price. So we got a low price of 99. You would want to buy it under 99 if you believe this low scenario. A mid price of 122. You would want to buy now under 122, which it is right now. Stock's at 107. And then a high price if you believe this high scenario of 150. If you're looking at least a 10% annualized return, this would be where you would buy the stock. So these scenarios show that it's a buy. My own little forecast here shows it's a buy. I don't just believe myself. I don't just believe some scenario. Again, anything could happen, but Morningstar is a very respected firm out there. They're pretty conservative. They have it as a 4-star rated stock. They have the fair value at 169. It is a wide economic moat, exemplary capital allocation. They say Alphabet missed Q2 expectations, but cloud growth impressive and advertising is intact. Fair value estimate to 169. So they did bring it down to 169 from 180 previously. but that's still a lot of upside from here. It's actually more bullish than what I was talking about. Let me know if you're a Google shareholder, if you plan on buying shares. Am I wrong with this analysis? Let me know in the comments below. See you next time.